All right. Okay, hello everyone. Welcome to the Art of TradeStation. I'm David Russell, VP of Market Intelligence at TradeStation, and today we're going to be looking at some of the ways you can use a TradeStation platform for fundamental analysis. Before we get started, I wanted to read this important disclosure. The following presentation is for educational purposes only. All symbols and trading ideas discussed by the instructors are for demonstrational purposes only and are not recommendations. This presentation is not an offer or solicitation of any kind in any jurisdiction where any TradeStation affiliate is not authorized to do business, including but not limited to Hong Kong and Japan. Active trading is not suitable for everyone. Options and futures trading carries a high degree of risk and is not suitable for all traders. Please read the disclosure information handout or the electronic disclosure information available on the TradeStation website. Okay, so today we're going to go through some ways that you can use the platform for fundamental analysis. A lot of people know how TradeStation has great technical analysis, but there's quite a lot of functionality to look into things like earnings and revenue and margins and stuff like that. We're going to look at that. First, what I want to do is I wanted to share with you guys a zip file. This has, I'm going to share this. This has some custom tools in it. So when you download the zip file, if you go to the chat in Zoom, if you download the zip file and you see, this is what you're going to see. You're going to see 3 items in the zip file. First is going to have this PDF, which is basically the slides for the presentation today. Then you have this easy language document file, and this contains a bunch of indicators. So first you're going to load this in the TradeStation. When you loaded it, you'll see something like this. It brings up an import wizard, and then you'll see this. It has a list of indicators. I already have them, so I'm not going to do this. But if you hit finish, you'll import them. If you've been in some of my other webinars, some of these you may already have. And just realize that if you do overwrite the existing ones you have, if you've made any changes to it in your easy language, it will destroy those changes and revert to the version that I'm giving you. So just so you realize that. Once you've imported the indicators, you can then double click on this Art of TS Fundamentals, which is a TradeStation workspace, and this is what I now have open. So while you guys are working on that, I wanted to just quickly just show a few other things I wanted to mention. If you guys want to look at a lot of the work that I do for TradeStation clients, you can go to TradeStation.com. Let me just, here we go. If you go to TradeStation.com and you go to Insights, this is the blog, the Market Insights blog that I run. And you know, I do a lot of different things. I look at sectors and different kinds of technical analysis and fundamentals and market trends, ways to use option strategies, a lot of different information I try and provide for people. One of the things I thought was interesting, I did want to kind of mention here was really 2 things stand out to me that is kind of interesting. First of all, I write this article here about how inflation is kind of funny. Today, the Fed comes out and says they're going to taper asset purchases. But the ironic thing is that inflation is really unwinding before our eyes. Lumber went back under $500 last week. Oil is collapsing. I want to just very quickly show you the chart of crude oil and copper, which are 2 of the big indicators. Here's crude oil and here's copper futures. These are 2 of the big indicators for for inflation, and these have both been trending lower since May. So has lumber. So I just think it's interesting now with the Fed tapering and the likely upward pressure that that we're going to get on the dollar. The other thing to think about is the fact that the Chinese have done a lot of things to slow their economy down in different ways in the last few months. That is also something that weighs on that weighs on inflation. So it's interesting to see these things all kind of happening now. But I also think it's important just to take a really quick look at the S&P 500 here. We look at the chart, and if you look at this, this is something here that is called a hanging man candlestick up here. This is a bearish reversal pattern, and we seem to have some confirmation of it here. So one of the other things that I've written about recently was the fact that let's just draw some quick trend lines here. You can actually see here that, essentially, wait a second, like this, and then a second trend line kind of along these lows. And you can see in many ways that this is, it was more the case over here before that one out, that big candle. But essentially, we have a little bit of what you'd consider an ascending wedge, which is when the upside it goes up more slowly than the bottom of the support coming up. And this is another thing that is something of a bearish reversal pattern. So, we're getting into a point of the year when it's relatively less active. A lot of the things that have been happening so far, from a positive perspective, have kind of happened by now. One of the things I wrote about on Market Insights as well is the fact that some of these technology companies like Amazon and Netflix and some of them, a lot of them, their growth is kind of really to a certain extent shown signs of peaking. Now, that being said, it's important to realize that we just finished. If you look at this article right here with the woman with the mask on, we finished the best earnings season in a long time. Since 2009, the fastest revenue growth since at least 2008. Some really dramatic numbers that we break down in this article here, this record earnings season. So when you look at this, there's a lot of there's still a lot of things that have recently happened. And when you get that kind of earnings growth, the idea that you get any kind of dramatic, kind of prolonged bear market so quickly after earnings growth like that, it's not really something that has historically happened. So on the articles we have here, we outline is actually a great deal of boring stocks that are really not the kind of companies people enjoy trading. Things like life insurance companies and property and casualty insurance companies and medical devices and pharmaceuticals. Some of these stocks have been breaking out at the same time the rest of the market has been kind of quiet. So I think it's interesting to think about here. If we get some periods of weakness in the market, the leadership on the other side of it could be very different than what we've been accustomed to seeing. There's evidence, in my view, that the healthcare sector might be entering a period now of outperforming for several years. And I think it's something that we might want to keep our eye on. Before we go into the webinar, I did want to actually mention that if you actually on September 15th, I'm going to be doing another Art of TradeStation about scanning for pullbacks and things like that. So be on the lookout in case we do get in any kind of pullbacks or any kind of corrections in the market over the summer. That we could actually, I'm going to be coming back and doing another webinar about different ways you can use a TradeStation platform for exactly that sort of, situation of finding opportunities amid pullbacks. A lot of functionality, and I've done that webinar a while back, and there's a lot of interesting tools I have in it. The last thing I want to mention is there's 3 stocks in particular that have caught my attention among the recent kind of weakness, and all 3 of them are relatively new. This stock MRVI is they're like a biotech, Illumina, ILMN. They're like Illumina, kind of, what I can tell. They do biotechnology stuff. They did an IPO not that long ago, and what's interesting about a stock like this is that it is new. And what's interesting about that means that there's not a lot of people who are long-term holders who can become sellers. This is a new company that has been outperforming and moving higher as the market pauses. Another one is GLBE. This is a company that has a partnership with Shopify, and they do some e-commerce services. This is another company with some explosive revenue growth, also a new company that might not have established holders. And the last one I wanted to mention was Palantir. This stock suffered. It did nowhere after its initial IPO. I mean, it doubled, I think, off the IPO price, and then it just did nothing for all year. And here we are on a day when the S&P is down close to 1%, or actually is down 1.3% today. Here we have Palantir up 4%. This is another interesting sort of thing. So what can be interesting about a market like this is you start to sometimes see who the leaders are going to be in the next sort of the next phase, and we might be starting to see that now. Okay, so let's get back to this, and let's just take a look now at some of the things we're going to be going through. I showed you how to load the custom tools. The next thing we're going to talk about kind of opportunities and challenges in the market. How do you scanner on TradeStation and the custom workspace I gave you, and then understanding different kinds of fundamental indicators, different ratios that make sense for different sectors. And then one of the things also is scanning for comebacks as we continue to kind of come out of the COVID crash, and how do we find some of the companies that were maybe really beaten up during that crisis that are coming back. And then I want to also break down a kind of framework that I have created to understand stock movement in a way that you can quickly apply fundamentals in a way that you don't have to be an expert. Because one of the things that can be frustrating at the stock market is that, there might be sectors you don't particularly like. I mean, who really likes, I mean, no offense, but no one really likes property and casualty stocks. Most people, we enjoy our technology stocks, our growth stocks. But the thing is, there's certain times when that's not where the market wants to be. Certain industrial stocks. So I'm going to give you guys some intellectual tools to understand those companies without having to be experts in them or spending a huge amount of time learning their businesses. There's certain patterns you can identify, which I'm going to show you. All right, so the opportunities in the current market. So that when we look at the equity market now, I think it's interesting. There are significant opportunities in both growth and in value. So growth are things when the company's business itself is in a long-term period of expansion, something like e-commerce or cloud computing, which didn't exist 20 years ago, and now it's surging. So because of changes in technology, healthcare, and communications, which is massive, things like digital media, things like social media, streaming video, all of these things and all kinds of multiple iterations and the next generation of these different things going, I mean, even Facebook now is old news. And at one point, maybe Reddit will go public, and that, just think of all the way these things just keep changing. That is growth, and it's driven by that kind of innovation. But then you have value. And when you look at the value concept of investing, that's driven by the fact that the economy is recovering. It's growing, 4, 5, 6%, depending on how exactly things work out. But we're looking at an expansion in the economy, significant employment improvement, 10 million unfilled jobs, wages are rising, people have a lot of money on hand, and spending has signs, for the most part the spending is going to do pretty well. Then at the same time, which I think is very interesting that a lot of people don't look at enough, is that there were certain sectors that were abandoned after the 2008 financial crisis and after the crash of emerging markets in 2011. There were sectors like financials, industrials, material stocks, things like steel stocks. Look at U.S. Steel today. U.S. Steel hitting new highs. Why? Well, the fact is there are certain parts of the market that have simply been under-owned for a decade. And it's interesting just to see the money shifting back to those. So we have right now a market that has a very powerful set of factors with a lot of growth stories and a lot of growth and a lot of value opportunities. So we can apply fundamental analysis in all these different things. Now, I mentioned IPOs and SPACs. I'm not going to be talking about it very much today, aside from what I already said about like Palantir. But I did want to mention, if you have the PDF, the slides of this webinar, there's a link to my previous webinar about how to find IPOs and SPACs, how to analyze them using TradeStation. Okay. So I do also want to mention, though, that fundamental analysis has its limitations, and I am fundamentally at heart, I take a macro view of the market. I try to assess what sectors are working. Are we in a cyclical growth, a secular growth? Are we in a period of fear? Are we in a period of rising or falling volatility? To me, that matters much more than fundamental analysis. So, we always need to realize that things like interest rates, economic growth, inflation, commodities, all these things can have a much more important impact on the market than fundamental analysis. And knowing the current sector performance can help you avoid weak parts of the market. And also in the slides here, I provided a link to another one of my recent webinars about how to track and find and keep track of those macro trends and the sector strength. We're not going to be talking about it today, but I do want to emphasize that that is extremely important. And it's something that you should not you should not ignore and say, well, this company has good fundamentals, so therefore I'm going to ignore the macro environment. And that's even more important now with the Fed tapering. This is now going to be an important sort of narrative. Okay, let's see if I have some questions. What would the stocks I mentioned? Yes, MRVI, GLBE, PLTR. Good, I see someone there sharing that. I'm just making sure I don't miss any questions. How do you download your ELD? There you got the link, and I'll just really quickly one last time show you guys here. If you have the zip file open, you're going to see these 3 items. This is the actual PDF. This is the workspace, but you first want to load this thing, the easy language document, and it will bring in this wizard, and then it will bring in, these are the indicators. You hit finish, it will bring them in. Okay. All right, so let's get to actually looking at some of the things we can do here with the TradeStation platform. So first, I'm going to actually open up a new window on TradeStation. This is the workspace I gave you, but just to keep things simple, here's Scanner. And now what I'm going to do is I'm going to show you guys how to do some things with Scanner first, because this is, I think, just right off the bat, the best thing we want to start with. Scanner has all kinds of tools built into it and values built in. So if you don't know what Scanner is, I just, if you go up here to apps and then you go to Scanner, it looks like a flashlight. Now for you guys, it's probably not in the top left. It's probably over here somewhere. You can move these around, which is really nice, but Scanner is usually somewhere else, but it's the flashlight. And mine, now I wish I could share scans with people. It's one of the limitations. Unfortunately, I cannot. The scan, you have to build it yourself. So that's what I'm going to show you how to do right now. I have a whole bunch of scans here, as you can see. So I'm going to build one. I'm going to create a scan. I'm going to call this one. I like to just date it, keep things simple. I put an exclamation point. This will put it at the very top of my list. I always date things with this number code, like so 2021. You can call it whatever you want. I'm going to call this LT. I'm going to call it 2021-08. 0818, for October 18th. And then I'm going to call it LT Rev Growth. Okay. So here's how we're going to do this. You have to name it first. Hit next. You're going to all stocks. Now, the first thing we want to do is we want to add a capitalization standard. So we're going to hit next. Now this is the point when it wants to see the criteria. So I'm going to say capitalization, market capitalization greater than, and this is all, I'm looking at slide 6, by the way, in your workspace. This, I'm going to set it to greater than 1,000. Okay. And next I'm going to go profitability. So next criteria. So that's going to be, this is in millions. So that means it's going to find market caps of at least $1 billion. Obviously you can change it. This is just to, this is just going to, bring up a whole bunch of results. I want to be able to show this to you. Next, we're going to go to profitability. So these are under different buckets. And then you go to profitability, revenues, and then you want to go to revenue growth 5-year rate. So revenue growth 5-year rate. And that's going to be a percentage. So it's going to say greater than 30. Now, just one thing to be careful of is for these, like if you're working with Scanner, a percentage, 30% is going to be 0.3. With revenue growth, it's going to be 30. So just realize a few of these things are not exactly the same. So just realize that when you deal with Scanner versus radar screen. Now here's the thing: a company might have 30% revenue growth, but it might have like $10 million of revenue, and that can be annoying. So let's go now to the next line. This is just a percentage change. The next thing I'm going to go to revenues. TTM, which means trailing 12-month greater than 1,000. So this is now going to be, again, it's in millions. So what this is going to do is, this is going to find companies. Here's what I just did. It's going to find companies with $1 billion in market cap, growing revenue at 30% a year, but also have at least $1 billion in revenue. And that will eliminate your random, weird little companies that, have unusual numbers. Because the problem with whenever you're doing any kind of data is you can get anomalies. So let's do run. It's always good to set a benchmark, or a minimum, because sometimes you're going to find companies that might have, really fast revenue growth, but maybe they only have a small amount of revenue. Anyway, all right, so this gave us a very quick set of results. And if we look at the very top of our list, the great thing about this is you can sort by the different columns. And this is going to show us right off the bat, our big names are obviously things like Facebook and Tesla. But then the thing I love about this is you can then you can sort by seeing who's up or down the most. And then what you can do is you can just copy these. And this is set right now, for example, I'm going to just show you radar. I'm copying it over to the workspace I gave you. I gave it to you the S&P 500. I can do select all, delete, paste them in there. And now you can compare this set of companies as well. So that's how easy it is to be able to do these scans. All right, so that is the one of companies that have longer term revenue growth. One of the nice things about this is you can double click on it. You can then go to schedule and you can schedule it to run automatically. In this case, I don't think this one is worth scheduling because after all, when you're looking at 5-year revenue growth, that number is not going to change very often. But some of the other ones could be worth repeating more. So now let's create a second scan. This is going to be slide number 7, short-term revenue growth. And this one, we're just going to do something slightly differently. So in this one, we're going to, let's just call it 20210818, and then we're going to go to next, call it ST Rev Growth. Now I'm going to go to all stocks, next. We're going to go once again to capitalization greater than 1,000. We're going to go to, now this one, we're going to do a different revenue growth. We're going to go to financial strength. I'm sorry, we're going to go to profitability, revenues. And this time we're going to go to revenues percentage change. TTM, which means this is going to be the trailing 4 quarters compared to the previous trailing 4 quarters. And this one we're also going to set to greater than 30. Oops. Now, in this case, there's just one thing to think about. For companies like this, another way to think is that, you know, I'm going to say just greater than 500 and not, wait, this should be 1 billion. And the reason I'm doing this is a newer company might not yet have reached $1 billion of revenue. A bunch of these newer software companies, or some of the ones I mentioned before, they're somewhere between 500 and $1 billion of revenue. There are sometimes explosive, growth stocks that are, they have not yet reached that mark. And very often the ones that have the most exciting performance are the ones that have not yet kind of reached $1 billion. They might be the ones that are in that kind of, some of these are growing really quickly. I mean, one of the ones I find most interesting is Argen. I've been watching this stock for years. But anyway, so this is going to now find companies that are growing a lot in the last year. So it's just important to recognize some of the different ways you should be thinking about this. And in terms of, here we have, of course, Moderna, which is interesting. I mean, this now is escalating so quickly. But if you were back a couple of quarters ago, Moderna's revenue was not nearly that high. So okay, so that's the slide 7 for shorter term. And then the next one I want to show, and I'm going to explain this one, but wait, all right, this one is going to be, this is slide number 8, and this is long-term cash flow growth. So we're going to do another one. Now, the thing I like about this is that this is going to find companies that have been increasing their cash flow over the longer time. Now, cash flow is interesting because it excludes a lot of distortions that can come from different kinds of extraordinary items or non-core items on the income statement. I'm going to explain that in a second, but first let's name this. I'm going to call this LT cash flow growth. Okay, same thing, all stocks. Going to go once again to $1 billion. And what I like to do, I'm not going to show you how to do it in this webinar, but I like to take these and then cross-reference them with technical analysis in terms of, and that's one of the things I do in the other webinars, but you can then take the list from here and then dump them into radar screen and then find them when they are pulling back to moving averages or have other technical events. And I'm going to cover a lot of that next month. So sorry, I'm going to go here to capitalization, market capitalization greater than 1 billion. We're going to go to, this time we're going to go to the bucket called financial strength. Okay, and we're going to go to cash flow. I'm going to go to cash flow growth rate 5-year greater than 30. And the next, I'm going to go to profitability. Now, once again, we also want to make sure that the company actually has, a decent size of revenue. So we go back to profitability, we go to revenues, and then we're going to go to revenue TTM greater than 1,000. Revenues TTM greater than. And also this should be, I put the wrong number there. Now you're going to notice how quickly these scans move, which is really nice. The reason why some of the other ones I've taught, the scans go a lot slower because they use custom indicators. If you use an indicator in Scanner, like if you look at this here and you go to, you go down here to include an indicator, like moving averages or other different indicators, it's going to go a lot slower. So just so you realize what we're doing here is this will find, Scanner has certain values built in that go really fast. So just realize that when you use something in Scanner and you are building your criteria off of these set of folders up at the top, and you see these folders, anything under these buckets is going to go really fast. Once you start using indicators and show me's, it goes a lot slower. They can still be super useful, but it could take a scan, instead of taking 3 or 4 seconds, it could take 3 or 4 minutes or longer, depending on how many indicators you have. All right, so let's take one last look at the results here of long-term cash flow growth. And let's take a look at some of these. I like to just look and say, let's look at the biggest revenues to the smallest. And not surprising, we have, some of our big sort of, names here that you'd expect. Now, some of these are not growing as much as others, but then you can also sort by the actual revenue growth, and you can actually start to discover some interesting names here. I mean, honestly, one that I'm interested in right now, that we talked about a while back, is also Louisiana Pacific. This is a lumber company. I think home builders right now are in just a fascinating place because, like I said, lumber prices have just absolutely cratered. And there is no sign of the housing demand slowing down. I mean, there's definitely people who are, triggered, scared of the home price appreciation, and they're hesitant to buy. But right now the supply demand balance for housing is still very favorable, and the kind of income and savings people have, the repair to household balance sheets, is all favorable for housing here. So this is interesting to me to just see Louisiana Pacific on this list. Okay. So this finds companies with growing cash flow at least 30% per year in the last 5 years, $1 billion of revenue. And this looks past negative earnings per share anomalies, which I'm going to explain in a minute. First, I want to explain to you the workspace that I have shared here. So this was just a blank workspace I created to show you Scanner. I'm now going to show you, this is the one that is in the zip file that I shared. And now this has a series of indicators. Now, in Scanner, these criteria that are here in Scanner, these live in Scanner, and these are not available directly in Radar Screen. So what I've done is I've created a series of custom indicators for you guys, which are in these columns. So these are custom indicators. This is Dave Russell's coding. I'm not a developer, but the great thing about TradeStation is that you can do some pretty interesting stuff when you open up Easy Language and start learning about it. In fact, we do Easy Language during our master class, and I think we want to share a link to that. If you have, Nico, if you could please share the link for master class. Jesus Nava is the main instructor in master class, but I do it some. Jesus is good at Easy Language. We have some Easy Language pros in there. If you just to quickly show you how Easy Language works, I created, for example, this thing here called margin change. Okay, what this does is this looks at a company's profit margins a year ago versus the most recent year compared to the previous year. And then what it does is it shows if it's getting better or worse. And from this, you can see that Shopify had the biggest earnings improvement. Oh, this is the list that I pulled out from from Scanner. I can then just look at the S&P if I select the whole thing, and then I go to data, S&P 500. And this is now going to show companies that had, big margin improvements using this indicator. And you can see in the S&P 500, DuPont actually had the biggest margin improvement. Now, in some ways, this is kind of not a surprise because some of the companies during coronavirus, they had a huge drop in earnings, and now as they return to normal. So you do get some anomalies in there. But this is an indicator I created. So let me show you how this Easy Language works. I go to Studies, Edit Easy Language, and you can see my code here. This is the TradeStation Easy Language environment. So if you look at this now, I want to just mention that this was all stuff I created myself. this pulls out values that are available. We have all this fundamental information that is available to you guys, and the easy language can extract those. And we teach you in masterclass how to do that. Now, what this can also do is these have comments, these slashes, but you can now I can remove those if I want. If I hit F3, it's going to now go over here and change the indicator and add these columns. And this will actually show, like, for example, so you can see DD, the profit margin in the trailing 5 years. I'm sorry, this doesn't go year to year. This looks at the last 5 years. It compares the last year against the base of the previous 5 years. So you can see improvements. But anyway, what this shows is you can see that it went from a profit margin of, very low reading of less than 1 percentage point to 7 percentage points, which is a huge gain in profit margins for DuPont. Now, these numbers are just, for me, all I really care about is the improvement. So I'm going to go back out to my easy language now, and I'm going to, hide these again. But this is just the sort of thing you can do. It's very powerful, and I really encourage you guys to, consider taking that class, because there's all kinds of, this is just a tiny kind of example of what you can do with it. Okay, so when we look at this, these are price changes. And this will show, for example, that in the last 21 sessions, or the last month, roughly, trailing month period, Nucor and Moderna, Nucor is a steel stock, Moderna is the vaccine company. These are like the top performers in the S&P 500. 63D is 3 months. And this is also 1 year, 250 sessions. I like to have it like this because this is just very simple. If you say 1 month, that can be slightly confusing because it depends, does that mean month to date? Does it mean that it matches exactly, the calendar month? It doesn't mean that. You might have a month that is, not as many days as the other. For the most part, most months are 21 trading sessions. So that's how I set it up like this. Most years are approximately 250 sessions, or 250 bars if you have price history you're working with. Next, we have the obvious PE ratio that everyone knows about. We have earnings growth rate. Now, a lot of these are also obviously distorted because of coronavirus, and you have some companies that had huge declines that have rebounded or whatever. But this is just earnings growth. The one I showed you, margin change. Price to free cash flow. This will allow you, I'm going to explain that one in a minute. Price to sales, which I find extremely useful for software companies in particular and pharmaceutical companies. Price to sales can be a very valuable one. Now, next we have revenue growth. This is what a custom one I created. And what I like about this is this shows you both the revenue growth as a percentage, but it also shows you the actual base of revenue. Because if you have a company with relatively small revenue, like FANG, which is an oil stock, who really cares if it grows 295%? It's a $4 billion revenue. Again, that's an oil stock. So its revenue probably went down like 70% during COVID, and now it comes back. So this allows you to put everything in context very quickly, which is what I always want to do. I want to be able to compare things one column to another to quickly, assess a broad number of companies. Now, price to book is very useful, and I'm going to explain these in a future slide, but this can be very useful for value investing. Enterprise value to market cap is a custom one that I've created, which I find to be the most universal leverage measure of leverage. I'm going to explain that one too. Book value growth per share over the 5 years is a good long-term value of measure of growth. And cash flow growth. This is very similar to the thing I just showed you in Scanner. Next, this includes sector and industry. Now, that can be useful because it's really important to understand that when you're doing these financial ratios, is that for the most part, you want to compare apples to apples. You're going to see, for example, that a lot of banks, for example, like if you look at, I think they're called like regional banks here. These are going to, for the most part, have similar PE ratios. Technology stocks might have similar PE or price to cash flow or price to sales. So you don't want to compare the PE ratio of a bank to the PE ratio of a biotech or a software company, because they're not comparable. So it's important to be able to quickly put things in context. So this shows you the ability to quickly sort on all these different things and to understand where companies, how they size up against each other. And the great thing about this is it also has price performance, which allows you to compare those things. Okay, so now we're going to look at different ratios for different sectors. Let's start with slide 10. All right, enterprise value to market cap. Now, this is, in my view, the universal measure of indebtedness. Let me just say, I actually originally used to work in the credit market. I used to work at Bloomberg, and I did a lot of stuff with corporate credit, companies issuing investment grade and high yield bonds. So for me, credit is really interesting. It gives you an interesting understanding of companies' finances. It's really kind of inside baseball, but it can give you an understanding of companies in a way that equity investors often overlook. The thing about enterprise value is, what enterprise value is it's the market cap of a company plus its debt minus the cash, which is a true measure of a company's value. So just imagine, for example, that you have a house that is worth $1 million. Okay, that is the enterprise value of the house. But now, say you have an $800,000 mortgage on it. That's your debt, right? So your equity is the market cap. So that house would have an equity of $200,000, $1 million value, 800,000 of debt, 200 million of equity. Now, say in the kitchen cabinet, there's another $1 million in cash, just $100 bills piled up. Well, now that if you're going to buy that house is now worth $2 million. Now the house isn't worth $2 million. It has cash on the balance sheet. The cash sitting in the kitchen cabinet is going to offset the mortgage. So to understand the true value of the house, you have to subtract the cash back out. And that's what enterprise value does. If a company has a ton of cash on its balance sheet, it gets subtracted out because that's not really the value of the business. That's just extra cash. And if you're going to come in, if you're, a private equity firm or another company going to come in and buy that company, you've got all that cash. So you can then borrow money and then take their cash and pay down the debt that you borrow using the cash. So this enterprise value is a very valuable and useful measure of indebtedness. When a company's enterprise value is greater than its market cap, it means that its debt is higher. And the higher up you go, in terms of enterprise value to market cap, you're generally going to be more leveraged. Now, it should be high for banks and pretty high for utilities because utilities have very steady businesses. They can afford a lot of debt because their business doesn't fluctuate very much. Banks essentially borrow money in the form of deposits. So they have higher enterprise value as well. So when you see companies that are industrials or energy stocks and they have high enterprise values, that can be a sign that they're at risk of bankruptcy or something like that. So if we look again at the S&P 500 and we look at enterprise value to market cap, look at the companies with a high EV to market cap. You're going to see banks, Northern Trust. I think that NTRS is Northern Trust. We have Goldman Sachs, Morgan Stanley, Schwab, and then boom, there we have Ford Motor. Boom, there we have American Airlines. Now, American Airlines is not exactly a AAA credit. They've got a lot of debt, very volatile business, and Caesars casinos. A lot of these casino companies have a lot of debt. Some of these oil companies, like Apache, they might not have had a lot of debt before, but then what happens is that as the price of oil goes down and as COVID and people move away from traditional fossil fuels, people have less desire for their assets. So what happens is the enterprise value as a percentage of their market cap increases. And that actually shows you that they now are a more leveraged company. So this is a really useful measure that I really like. It's one I created, but the thing I like about it is it can span all the different industries. You have other things like, debt to equity and things like that, which I just have never found as universally applicable. The PE ratio, typical price to earnings, it's useful for peer-to-peer comparisons. It can vary widely between industries, as I said. Now, the one thing to be careful of the PE ratio is the value trap. You want to be very careful of companies that have low PE ratios because it can mean that the market does not respect them. Very often, companies with higher PE ratios are the ones that the market really views as being quality companies. So you got to be careful of things that look cheap. Price to revenue can be especially useful for software companies and IT services. Again, you want to be looking at things in a peer-to-peer comparison. All right, price to free cash flow is useful for technology stocks. Now, the reason is say you're Mark Benioff at Salesforce.com. The guy has bought all these different companies. He just bought Slack. He bought Tableau Software. He bought MuleSoft. As he buys those other companies, those come onto his balance sheet as an asset. Now, remember, if you're buying something or you're making an investment, you have to depreciate that. So if you buy a company like Tableau Software and you spend a premium for it, you then have to amortize the goodwill or the extra value that you paid to buy it, the premium above its asset value. So the problem is that certain technology companies, when they buy each other, they end up with very high book values that are not real. And then what they have to do is they have to depreciate that down. So every quarter they're taking losses on, but it's all accounting. And so what happens is their earnings are much lower than they really are, their earnings per share, because the earnings per share include the impact of depreciation or amortization of goodwill. So the thing is that free cash flow will exclude that because it essentially takes the earnings and then it adds that depreciation back. So price to free cash flow is a way to value stocks that looks past these the accounting mechanism of depreciation. Earnings growth is the most universal reading of earnings growth. It can be used inversely after a recession. One thing I like about something like earnings growth is that very often it's actually a good contrary indicator. So when we came out of COVID, if you look for companies that had the worst earnings growth, like the airlines and cruise ships, those are the ones that kind of bounce the most. And very often, going into a recession, the companies with the highest earnings growth rates will be the ones that fall the most as the recession starts, as the downturn happens, because those will be the ones that have the most optimism priced in. Book value per share 5-year growth is going to show companies with your long-term secular growth. And let's take a look at that. Book value growth to share 5 years. You have Tesla, INSEE, Ingersoll Rand. The only thing is this company had some mergers in there. But Ingersoll Rand, this is not their actual growth because they had mergers. But a lot of these other companies, are legitimate long-term growth, like Amazon and Paycom. Long-term, these are companies that are in long-term secular growth phases that are worth looking at. Salesforce there and Amazon, KLA-10 Core and Netflix. The great thing about this is we know a lot of these stocks. So there's a few on this list you probably forgot about or didn't know about, and this scan will find them. And again, with Scanner, you can find these as well. All right. So another thing I want to mention that I think we need to understand earlier this year, and I wrote about this a lot on Market Insights, is the idea of growth versus value. And interest rates went shooting up, technology stocks took a hit, and you saw people going to value stocks, and was emphasized on growth versus value. And I think with the Fed tapering again, we need to at least be aware of this dynamic. And the idea is that everyone talks about PE ratios, and the idea is that you want to look at the price against the earnings. So a higher reading is more expensive. A company trades at something like 20 times earnings. They have a $20 stock price with $1 of earnings. That's a PE ratio of 20. But in some ways, it makes more sense to flip the number upside down. And most people don't do this, but if you can think this way, and then you get what's called earnings yield. So imagine dividend yield. The company pays a $1 dividend. It's a $10 stock. That's a 10% dividend yield. Okay, well, you can do essentially the same thing with earnings. So if you take earnings to price, you get the earnings yield. And in this case, low readings mean the stock is more expensive. For example, if a company has a low dividend yield, it basically means they don't give you a lot of dividend, which means the stock is expensive relative to its dividend. Bonds with low yields are relatively expensive. So the thing is that there's a concept called the Fed stock model, which goes back to a Federal Reserve paper in 1997. And what it says is that the earnings of the S&P, the earnings yield of the S&P 500 over time should approximate the 10-year Treasury yield. So if you look at the current, and I did this over the weekend, but basically the PE ratio of the S&P 500 was around 22 times the earnings yield, which translates into an earnings yield of 4.5%. Again, we just take the earnings and divide it by the price to get the earnings yield. So that's about a 4.5% yield. The 10-year Treasury yield is around 1.3%. So based on this, The S&P 500 is not overvalued based on the model, the Fed model. And a lot of strategists and long-term, stock market strategist guys, they use some version of this model. What they'll often do is, you're going to adjust it for where you are in the economic cycle. At the end of the economic cycle, your earnings are higher than they should be. At the end of a recession, they're lower than they should be if you normalize them for the economy going up and down. However, this concept of earnings yield and benchmarking it to the S&P 5 to the 10-year Treasury is a common strategy. The basic principle, though, is that if interest rates start going up a lot, it's going to hurt the companies with low earnings yields or high PE multiples, which is going to be your growth stocks and your technology stocks, your Amazons, your Shopifys. Those kinds of companies are the ones that are most at risk in an environment when interest rates start going up. And the companies like the banks and the industrials that trade at low PE yields or low PE ratios and high earnings yields are going to do better. And that's the reason why we see this rotation in the market between growth and value. It's important just to understand the actual mechanism there. Let's see if I have any questions. How can Moderna have a PE of 0? That is a good question. I'm not actually sure exactly what their recent numbers are. It's entirely possible that they have not yet had a full year of profitability. I don't get into it in this webinar, but you also have to understand that the market will price in things before they happen. The fact is, it's as near to a mathematical certainty that Moderna will have profits. It's pretty high mathematical probability with the amount of revenue they've been doing in the last quarter or two. So the market will price that in. We don't have the forward earnings, but for the most part, when you have companies that are mature and established, that's where it's going to work on this. All right, so now what I want to do is I want to show you. I'm looking at make sure I'm missing any questions. Good. Do I have an earnings yield column on radar screen? No, I do not. I could create one. All these values that we have on radar screen here, if you want, I don't have time to do this, but these are all pulled out of the fundamental data. If you want to monkey around with it, I'd suggest that you copy the code, create a new indicator, and basically divide by the number that you're going to get for your PE ratio. Divide 1 by this number, by the output, and you're going to get an earnings yield. You're going to have to tinker around to make sure that it shows as a percentage. You're going to have to go and adjust the studies and the edit, and then you're going to mess with the style to get it to be a percentage. But that's how you would do it. If you have any questions, again, we teach that in masterclass. Now let's show you how to find potential value plays. Let's go back to our scanner. And we're going to do is we're going to look for companies here that are basically that have a price to book under 1. That was another thing, that the book value is a company's equity, which is basically the assets minus the minus the liabilities. That's going to give you your book value. And then you want to see when a company has a market cap less than its book value, then that could be a value play. And what's interesting is a lot of the financial stocks in October were trading at like half of book value, and they doubled based on that. And a lot of them went, more than doubled. All right, so let's go to new scan. Let's call this one, 20210818 value plays. And we're going, this is slide 13. We're going to go to, I'm going to go to next. All stocks. We're going to go to capitalization. And then we're going to go to valuation ratios. Common and PBMRQ. That means most recent quarter. Now, the thing to remember, this comes from the balance sheet. Balance sheet is fine each quarter to the next. Income statement is only 1 quarter of earnings. So you need to have, if you want to understand a company's performance, you have to look at TTM, which is 4 trailing quarters, trailing 12 months of income or cash flow. But balance sheet is a snapshot at one moment in time. So that is okay for MRQ, most recent quarter. So we want that to be less than 1. It's just like if I look at your bank account, I know how much money you have. But if I want to understand how much money you earn, I have to look at a year of pay stubs. You understand? That's the basic idea to understand those two things. I just want to explain why in this case I'm using MRQ. In other cases, I'm using TTM. I want to say less than 1. Now I want to go to profitability. And then I'm going to go to revenues. And then I want to go to revenues TTM. Again, now I'm going to TTM because revenue comes from the income statement. And then I'm going to go to greater than 500. So this is basically going to find companies that have some normal amount of revenue, not some. Again, sometimes you're going to find these weird companies, or you're going to find a SPAC that like doesn't actually have any business yet, and you're going to find some weird stuff. And you want to, by saying that you're setting a revenue threshold, you're going to find kind of real companies here. I don't know what these companies are per se, but if you look at them, you can you can look at them down the list. This is like a financial stock, BHF. You can do better degrees of drilling down in this, but I want to just show you how this sort of analysis can work. I'm personally not of the mindset. I think right now that if companies, we've already come through that value bounce. And so right now, I don't think this is the most useful strategy at this moment, but I wanted to show you how it works. I really would be wary of some of these companies now because if they're still trading at such a low price to book, they probably have something more structurally wrong with them. Like some of these energy stocks now, just because they're cheap, I don't think that necessarily makes them value plays. But I wanted to just show you how to create this. All right. So these tend to be highly cyclical and or distressed companies. So when you come out of a crisis, come out of a recession, those stocks can go up the most. At this point, not so much. Technology stocks often have inflated price to book values because the balance sheet understates the true value of intellectual property. Just think about it. If you're a software company, you spend $500 million building a piece of software, you're going to carry on your balance sheet as $500 million, but then it might actually be worth a lot more than that. Therefore, your price to book value will be way higher than what you would expect, because the fact is that if you create successfully, if you successfully build, a software business with a lot of customers, it doesn't cost that much to build it. So you're going to be carrying something on your balance sheet that doesn't look very valuable. As a result, the price to book value is going to be very high for technology stocks. There's a reason for that. And that's why price to book is not a relevant reading for them. Okay. Heavy debt loads. We want to find non-financial stocks. The reason is because if you look for companies with a lot of debt, you're just going to get all the banks. And we want to find net debt greater than market cap. These may be value plays or stocks to look for bearish downtrends. So I honestly, sometimes if you can find some of these stocks, like the consumer staple stocks, when they break down, like Kraft did and Campbell Soup is doing right now, CPB, Newell Rubbermaid did it at one point in time. You can get some really steady downtrends if you want to be playing the downside. All right, so here's how we're going to build this. And this one gets a little bit more interesting. So let me show you how to do this. I'm running out of time as usual. I'm sorry. I just love teaching this to people. All right. So in this case, let's just call this, I just call it debt load. I only have time to do this really quickly. All stocks. And then I'm going to go to greater than capitalization. I'm going to go to, all right, now in this case, remember I said the buckets up here are fast. Now we're going to go down here to indicator. And this is going to make it a little slower, not too bad, but it's going to be a little slower. I'm going to type the letter E, and then you're going to find your EV to market cap. You're going to see it right here because you just imported it from the zip file I gave you. EV to market cap, and then you're going to say greater than 1. And then you're going to say, next thing you're going to say indicator, sector, does not equal, which is this greater than, less than operator. And then you're going to type the word financial. Make sure you put it in quote because it's a text string. It's not a number. It needs to be in quotes. So let's run this. And you'll notice this goes more slowly. Not terrible, but still it goes more slowly. So while that's running, I'm going to show you a few of the things with Scanner. Sometimes it's fascinating to look at the company get added to the S&P 500. And honestly, they added Moderna to the S&P 500 and it probably doubled in like a month. It can be really interesting to stay on top of companies getting added to the index. And one thing I like to do is I like to look for companies that I think are on the threshold of getting added. So what you can do is you can exclude S&P 500 companies. And this is the method of how to do it. You're going to do it in the initial screen here. So I ran this. You can see here where this generated. This is in the initial screen where I said all stocks. You can also exclude stocks. So if you look at in this symbol universe, I said all stocks. You can go down here and you can exclude the S&P 500 or the NASDAQ 100. And this is the path to follow in Scanner. This can find companies that may be added to the index or similar to index members. You can also schedule scans to run overnight. If you click on this button here for schedule, you can control when they run. It's nice. Some scans, if you want to make one with a lot of criteria, it might take 20 minutes to run or something. You can make it run overnight. And then you come in the morning and it's ready for you. All right. These were the results of that last one of my debt load scan. You're going to find community healthcare and some of these companies are, have a lot of debt. If you want to take a look at some of those, some of these energy stocks might, have some downside opportunities based on what I said earlier in energy. The other thing is that if you want to just look at a set of companies, if we go back to like long-term cash flow growth, look at all these. You look at these companies. I don't know what this is. I'm confused. What is this? Look at this trick. What you can then do is you can then go to scan criteria. You can go to indicator, and you can go to industry, and then you can say is not quote quote. This is a little trick that will basically force it to tell you the industry. So now when you look at your list, you actually have a little bit to go off and you actually know what kind of company am I looking at. And then you can go through the list and you can, look at it based on, industry. So that's a trick that I kind of created that can help you navigate more quickly through Scanner. Just remember when you're doing these, you need to have the quotes. Okay. Next, I don't have a huge amount of time for this, but I believe as someone, and I've written tens of thousands of articles about the stock market in the last 20 years. I believe that as you take a step back, that there are essentially 7 catalysts at any moment in time that explain why stocks move. Volumes and margins and macro trends are the 3 most important. Volume is simple. A company sells more iPhones, it sells more phones, it drives more, it has more passenger miles for an airplane. Whatever it is, it's doing more actual units. That can also include something like subscription. So if Netflix says, hey, we added X number of subscribers, that's the number it moves on because an analyst knows so many subscribers bring in so much revenue and that brings in so much profit. That's why no one cares what Netflix reports in earnings. The only thing anyone cares about is that subscriber number and the future number, because that is volumes. So it's important to think that way because volumes tell you what the revenue is going to be. And by the time it actually comes to revenue, you might have already missed the boat and it's already old news. That's why orders and volumes can be, that is the fundamental driver of a business getting bigger or smaller. But then you can also have margins. A company might be raising prices or lowering prices. I want to actually just very quickly point out, I did an article recently. If you go to events, earnings on Market Insights, there's the article with this guy here where the glasses are. Prices have been rising. And I basically show, I'm going to share a link for this. I basically explain how companies are using the perception of inflation to raise prices and make more money. And I wrote this back in July. And since I wrote it, basically, it has become, with a lot of people who study earnings, like they said, highest earnings, profit margins this quarter. that we got coming out of July, highest margins in history. But I wrote this at the beginning of July because I saw these trends that were happening with pricing and the inventory ratio that we break down here. So anyway, margins are a big driver. It mostly comes from raising prices or lowering your input costs. And then macro trends, like I said, when you're in an environment of rising interest rates, falling interest rates, that's going to impact, what people want to be investing in. And then I break through some of these other things like strategic actions, company transformation. Now, if you have the PDF that's in the zip file, all these have articles associated with them that you can click on and read the articles on Market Insights. Next, the thing is that certain of these items are under the control of management. For example, volumes and margins, macro trends. Companies cannot control interest rates. They cannot control if oil prices go up and down. They can control to a certain extent if they're selling more of a product or less of a product. And then I go through some key terms to look for. I don't have time to get into all of that, but these are things that might be just kind of useful. From my perspective, it's important as you kind of look through companies to be able to essentially, if you read like the earnings releases and other reports and stuff, you want to be able to catch those key terms. If you look, you want to look for things like margins, pricing, and those are some of the key terms that I outline in this in the slides. Very often, by the time it actually shows up in numbers, it's already been priced in. But hopefully, this kind of helps you guys. Like I said, TradeStation gives you a huge amount of flexibility in terms of being able to scan on all sorts of different criterias and analyze stocks on so many different criterias. So hopefully this helps you kind of see how it's possible to do all these things with scanner and radar screen. And again, this is just a small amount of some of the things that we actually can share with you guys. So I really want to encourage you to go to You Can Trade and check out the master class. And I'll be teaching that again next month. It'll be great to be back with everyone. And okay, that is, I'm just looking here. Those are all the questions. I've addressed them all. Don't forget, I'll be back on September 15th, and we'll be looking at how to do some advanced technical alerting and candlestick analysis. Hope everyone has a great day. Thank you very much.